Hit it.
It's June 12, 2020, episode 84. I'm Patrick Ceresna.
And I'm Kevin Muir. This week we interview Lyn Alden, where we learn how an electrical engineer became a macro expert. It's a fascinating discussion where we examine the fallout from the corona crisis and the unprecedented government response. Then we have a special guest appearance from Felipe Hirai and Jose Rocha from Dahlia Capital, where we learn about the unique opportunity offered by Brazilian equities. Finally, Patrick will interpret the tea leaves in this week's Talking Charts.
Then we get to this week's trading history, where we look back to the great recoinage of 1696 in England. Then we get to Taylor sharing his WTF clip of the week. And then we cap it all off with the top 3 things to watch next week. And Kevin, we might even drink some beers along the way. What do you think?
Sounds good. So stick around. We got a great show. Let's get to our first interview. Lyn Alden has worked for over a decade in the aviation industry in a wide range of roles, starting as an electronics engineer and moving into project and facility management and engineering finance. She currently runs the finances of the day-to-day operations of an aviation simulation research facility. She also runs an investment and research platform for both retail and institutional investors at lynalden.com. Her focus is on value investing with a global macro overlay with a specialization in currency differentials and equity valuations. Welcome to the show, Lyn.
Hey, thanks for having me.
Well, it's great to have you, and it's fascinating. You know, I was getting kind of briefed about your background, and it's not often that we get an electrical engineer on the show. So why don't you tell me a little bit about what you went to school and how you got into the finance industry?
Sure. Yeah. So I've been involved in investing since even before I went to engineering school. It was always kind of a passion of mine. But when it came time to go to college, instead of pursuing that route, I ended up pursuing engineering. It's one of those things you never really know why. I just kind of went that route. It was kind of a reliable way to get a good income, and I just found technology interesting as well. So I went into that route. Went to Penn State, and then. Started in the field of control automation for a little while, but then due to the 2008-2009 recession, my career shifted instead towards aircraft simulation. So we build research aircraft simulators for like research purposes rather than training purposes. But then from there, I never really let go of the passion for finance and for economics and investing. So I've always been doing that on the side, and eventually built that up into a business as well. So over the years, I shifted away from engineering and more towards engineering management, financial modeling, and that sort of thing, while combining that and the quantitative background with financial research.
You're a true propeller head or a rocket scientist.
Well, I work with rocket scientists. I'm more on the electrical side, but yeah.
Oh, okay. The and how do you find the interplay between engineering and finance? Like, do you find that the two people are completely different, or do you find that there's actually a lot of overlap?
Well, both are very broad, especially finance, because you can have more qualitative people in finance and more quantitative people in finance. So I think there's a closer overlap between engineering and some of the more quantitative aspects of finance. And for me, the big thing that really kind of influenced the way I look at macro is actually some of the control system analysis research that I've done in my engineering field. A lot of that applies to macroeconomics because you kind of look for bottlenecks and for feedback loops. When any sort of policy that's happening, you're always kind of asking, okay, what's going to be the pushback against this, or what are the ramifications of this? And it's kind of a similar way to think about it.
And do you think the fact that you weren't classically trained as an economist or an economics degree or even a finance degree is actually a blessing in disguise in some ways, because you're not kind of saddled with all the theories that might not be correct?
I think it helps kind of look at things from a fresher lens in a way. Especially, on one hand, it's a downside because you have to fill in gaps along the way, right? So over, years and years of doing it, you have to look up certain things and kind of get familiar with things that you missed in formal education. But on the other hand, you can kind of look at it with a fresh set of eyes. And then on the more micro level, because I look at individual companies as well, my degrees did focus on things like discounted cash flow analysis and financial modeling. So I did have some of the more, the smaller scale economics training in my education.
So how did you go about learning the macro side? Did you just read a lot of books, read a lot of articles, and who influenced you the most? Like, what were the things that you really felt like where there were breakthrough moments for you?
I gravitated kind of gradually towards macro because we're in a very macro heavy environment at the moment. So there are some decades where, it's more about individual stock selection, whereas other decades you have kind of these bigger changes in like long-term debt cycles or, major policy changes, more reliance on the central banks or fiscal policy.
Right.
So over time, I gradually saw that this is a very macro heavy environment. And I also just kind of felt that what I explained before is that my control system background, just I kept seeing more and more similarities there. And I kind of just felt that I had a knack for it. So I kind of started to keep with my more fundamental analysis, but then add that macro layer to it. And then
A-
there's all
And
sorts of
so,
different. Go ahead.
sorry, I didn't mean to interrupt. So, how did you go about like learning this stuff? Like, did you go and read papers? Did you read textbooks? Like, how did you kind of, which way did you head?
Uh, Primarily by looking at raw data. So by going back and just looking at different asset class performance over different decades, and then all the different variables that kind of went into that, and then trying to discern what were the primary variables, like which ones were distractions or which ones were kind of more causal. And then also, there's plenty of good books and teachers out there. I've generally found Ray Dalio's historical research has been very kind of interesting because he focuses on the long-term debt cycle.
Right.
And I found that kind of the most relevant, even though, he's had some shorter term issues. But
Right.
I think his long-term macro research has always been very fascinating.
So that's really interesting. So you went out and instead of trying to immerse yourself with other people's thinking, you went and looked at the raw data yourself and looked for relationships among those kind of different variables. What were there any surprises to you? Things that you were expecting that ended up being kind of almost the opposite?
Just finding out kind of the background of how much money changes over the long term, right? So a lot of people, when they measure performance, they focus on the numerator and they often ignore the denominator, which is currency
Right.
itself, right? So there are decades where the denominator is what really is moving real returns more than the numerator. And that was kind of fascinating to see when crunching the data.
Yeah, no, I can completely believe that everyone just deals in nominal dollars instead of real dollars.
Yeah.
Okay, so you brought some slides that you wanted to talk about. Let's jump into it here. So the first one is the initial and continued jobless claims. What are you thinking, and what's the story you wanted to tell with this?
Yeah, so over the past couple of weeks, that recent jobs report, the May one, made a really big splash because it kind of came in a little bit better than people were expecting. But what I found more kind of informative is looking at the weekly initial and continued jobless claims, right? Because
Right.
you get 4 times as many data points, so you get a data point every week, and you can dig into the report and kind of see some extra things about it. So if we look at this chart, for example, we of course had that giant spike in initial jobless claims, in late March in response to the pandemic shutdown, and it's come down over the past several months. It's still at very elevated levels, so we're still getting ongoing job losses, but at lower levels every week. Whereas continued claims, at least as the official number presents, it hit kind of a ceiling of 20 or 25 million, and it's kind of sidelined in that choppy motion. So we've been in kind of this job churn period where we're still getting job losses, but we're also seeing some people head back to work, and we're seeing kind of this rotation take place. And I've just found that this is a very useful way to kind of gauge week by week what the economy is doing rather than waiting for these monthly reports that have kind of extra factors in them.
Right. And so then the next chart here is the jobless claims with pandemic assistance. What is this chart talking about?
Yeah, so the official continued claims numbers of about 20 million, they understate the number of people that are actually out of a job because they focus on people that are suitable for traditional unemployment insurance, right? So
Right.
if you have a job and you lose the job, it covers that. But we have a lot of gig workers, self-employed people, right? And normally they wouldn't be covered in the same way. But because of the scale of this issue, the CARES Act that they passed covers a lot of these self-employed workers under the umbrella of the pandemic, the PUA, the Pandemic Unemployment Assistance Program.
Okay.
Uh, and so this chart just shows the blue line is if you look into the jobless report, the continued claims report, they have a broader number there that kind of shows if you add all these different programs together, what is the actual number of people that are claiming some sort of employment insurance. And that number is about 30 million at the moment, which is about 10 million higher than the 20 million headline number.
Okay.
And the primary difference there is that pandemic insurance, which is currently around 10 million people. And so that's covering a lot of self-employed people. So if you look at the official payroll numbers, right? So we started with, a little over 150 million people employed, and that decreased to a little over 130 million. So we lost about 20 million jobs, which corresponds with the ongoing 20 million continued jobless claims. But both those metrics don't really include self-employed people. So this blue line, and then particularly the orange subcomponent of it, kind of shows the severity of it outside of the normal employment routes, because it affects all these self-employed people as well.
Right. But on both those lines, they seem to have balanced and stopped going up.
Yeah, roughly in mid-May, we seem to have reached a peak where we're still people losing jobs and losing work, but we're also seeing some people going back to work. So we've definitely had a flatlining, which is a good thing. We've seen potentially a top.
And so that might have been the low in terms of the economy, would you say?
Yeah, but that's what we're going to get into in some of the next slides, is that it really comes down to fiscal support probably.
Okay, so let's have a look at the next slide.
Sure. This just shows, the market tends to bottom at the highest rate of change of economic damage rather than the bottom in economic damage, right? So this chart shows the past 3 recessions, and a lot of people commented that in this sell-off, the market was very disconnected from the economy. And in many ways it was, but in some ways it's actually just kind of misleading because of how compressed it was. So if you look at the past 3 recessions and bear markets, the market tends to bottom slightly before or during the peak in initial claims. So if you look back in the early 90s, we had the market bottom and turn up right before the peak in initial claims. And then 2000, because that was more of an equity bubble, that one took longer to play out. So we had the market bottom a little after the peak in initial claims, but around the same period. That was a longer bottoming process. And then in the very sharp 2008, 2009 crisis, once again, we had the market bottom, weeks prior to the top in initial claims. So instead of bottoming kind of at the worst part of the economic damage, it tends to bottom at the worst part of the rate of change of economic damage. And then when there start signs of like a top in the rate of people losing their jobs every week, that's historically when the market has started to kind of find a bottom. That's also when a lot of that kind of fiscal and monetary response really comes online.
That's fascinating. And actually, especially in the 2008 to 2009 recession, it was bang on. And so your argument is that because the job losses were so quick and so kind of condensed in terms of time, that kind of sped the whole process up, and then we actually stopped losing jobs and we stopped losing jobs at that increased rate, and that was when we bottomed as well in this currently 2020 depression or recession.
Yeah, and that's what the next slide shows.
Okay, let's have a look.
Yeah, so that's this recent period, and we don't know for sure if that was the bottom or just a bottom. But if we start with the assumption that it is the bottom, it actually is in line timing-wise with what happened in, say, the past recession, or broadly the last several recessions, where the bottom in the market came a couple weeks before the top in initial claims in rate of change terms. The weird thing was how compressed it was. In addition, it's somewhat weird how shallow the sell-off was compared to the sheer magnitude of the job losses, but the actual timing of it lined up with how previous recessions and bear markets played out, just very compressed.
Okay, so let's investigate what you just said there. In terms of the job losses, you would have expected, if other previous relationships had held, that the stock market should have gone down a lot more. Is that what you're saying?
Yes, you'd expect it to, because we've had the number of jobs lost in this recession was far larger than any other recession in modern history. But the sell-off is fairly kind of moderate by historical terms. It wasn't as bad as some of the prior recessions. So we've had a better performing stock market than you would have expected if someone had just showed you this raw economic data, a year ago and said, this is what's about to happen in the job market.
Right. And I think you have a theory as to why this is. And is it the next slide explains it?
Yeah, explain parts of it at least.
Yeah.
So yeah, in addition to the unprecedented, job loss and economic damage, we've had an unprecedented amount of fiscal and monetary support, which is no surprise to people at this point. But this chart kind of, I think, shows a pretty interesting part of it, which is normally during recessions, personal income goes down for obvious reasons. People lose their jobs, they go on unemployment benefits, which don't pay as much. And there's a lot of job turnover. Some people have to go on kind of partial unemployment. They get fewer hours. But this time, this data, the last data point came out in April, which was kind of the worst part of the job loss. But
Right.
personal income went up rather than down. So
Wow.
the blue line shows personal income in year-over-year percent rate of change terms.
Now, do you have a theory as to why that is?
The government report said it, and the data shows that it's true, that this is mainly due to government transfer programs. So this was because the $1,200 checks were sent out to people, and because the federal government gave $600 a month in extra unemployment benefits to people that are unemployed. So some of them were making more money in April than they would have made without this happening, right? So because some people didn't lose their job, but they still got checks in the mail. Other people lost their job, but the unemployment benefits covered most, all, or even in some cases more than they were making. So
that's right. I've heard lots of people pushing back to the idea that many minimum wage earners are actually getting more under these programs than they would have earned had they stayed working.
Some of them are, yes.
And so now this basically, therefore, translated with an increase in the broad money supply.
Yeah, the biggest we've ever seen in modern history, a huge spike. And that's basically because, multi-trillions of dollars in fiscal stimulus were passed. And rather than being extracted from the economy in terms of treasury issuance, when they issued the treasuries, they were basically bought by the Federal Reserve with new dollars through the primary dealers. So a lot of this represented just an injection of QE almost right into the economy by, in form of those $1,200 checks, small business loans that turn into grants, extra unemployment benefits, pandemic assistance, and then some of the more corporate bailouts, which they get into the economy in different ways, a little bit less direct.
So given the move that has occurred in terms of this fiscal stimulus, is it just any surprise to you that the stock market's rallied as much as it has?
Not after seeing all this program that happened. So when the markets were selling off sharply in March, people then didn't know what was going to happen. But as we've seen this play out for months, when you take into account all the different variables of how the timing played out and how large these fiscal programs have been, it definitely kind of shows why the markets were somewhat mitigated in terms of their damage, because you can almost think of it as a case where the denominator is being shifted more than the numerator. So we're putting so many dollars into the system, that it's kind of offsetting this big deflationary crunch that otherwise could be occurring.
Right. And back to your point when you originally talked about how macro is becoming more and more important and understanding all these things, do you think that going forward and forecasting the market over the next, 3, 6, maybe even a year, that this fiscal and monetary stimulus is going to be the most important determinant of future returns?
I think it's either the most important variable or at least one of the top few variables that's going to affect the markets as a whole. Yeah.
And so what do you worry about when you look at them? Like, what are you watching for? What are the signs that you're kind of, watching for? Do you think that we need more to keep the market up here? Or do you think that just keeping the programs as is enough? Like, walk us through your kind of the different scenarios that you're going through in your mind.
So I think at the current time, the market is very propped up by all this fiscal and monetary stimulus. And there are a couple of dates to watch as we move later into this year, right? Because there's certain decision points that could result in some of that being pulled away. So we have to be more on the lookout for potentially more of a deflationary crunch, more of a sell-off, or we could get a continuation or acceleration of some of these programs which could give the market more legs. So at the end of June, those small business loans that can turn into grants if you keep your employees on payroll through the period, they, quote, mature, meaning that they can start turning into grants if they kept their employees through the end of June, which means
Okay.
come July, some of the small businesses can start letting employees go if they don't need them anymore, right? Because they were kind of artificially incentivized to keep them on staff. It was kind of another layer of unemployment. So instead of those employees moving on to official unemployment roles, it was a way to try to keep them attached to their employer for longer, with the hopes that they would, by the time that the program ended, the economy would be strong enough that those employers would be able to keep their jobs.
Right.
So there's a few million workers, and we don't know the percentage that are going to be kind of kept on when these loans, mature, or what percentage of them are going to be let go. So that's kind of the first thing to watch as we see what the jobless claims do in July.
What's that program called, Lyn?
The PPP loans. I forget what that
Okay,
stands
that's
for.
the PPP loans that
Yeah.
everyone hears. Okay,
Yeah.
terrific. Okay, and what are the other kind of maturing of these programs that you're watching for?
Yeah, so the next step is late July, which is after July ends, all of that $600 in extra unemployment benefits that people receive,
Yeah.
those expire. So they go back to receiving their normal unemployment benefits, which are considerably less. So there's more of a penalty for being without a job rather than still getting, most or all of your income. Many people will be receiving considerably less income if that program expires. And it's been a little bit controversial because some critics of the program have argued that it de-incentivizes going back to work if you're making more money than when you weren't at work. When you
Right.
were working. But on the other hand, when you pull that away, we do see a risk of, we've already had some civil unrest, right? So imagine that with some of the extra money being pulled away. And then also, like, what can happen to businesses when consumers just have less spending money instead of more spending money, like we saw in April. So in April, they weren't spending much, but they were giving us all this injection of capital. We've kind of had the meme that a lot of that capital ended up in Robinhood accounts, right? But uh, but going forward, some of these workers could be more cash strapped because they're actually going to get more of a penalty for being unemployed rather than, kind of the money tap still flowing, assuming that is let to expire. So something to be at least watch out for in August.
And do you think if you had to discount the chances of either one of these or both of these programs being extended, what would you give the odds?
Well, the PPP loans, the date for them expiring is probably not going to change, right? Because that would actually harm small businesses in a way, because you basically say you have to keep your employees on even longer,
Right.
because they want them to turn into grants. So I think the one to really watch out for is the $600 extra unemployment benefit. And then for the PPP portion, the main question to watch is, so, as we go later in the next couple months, if we start to see continued claims winding down, if we see a spike in continued claims, it's probably because of some of those PPP jobs are kind of transferring over from supported by that program to supported on official unemployment. But then they become more people that would be reliant on the $600 in extra money that could be drying up a month later.
Right. And so now I'm just thinking this through, and a lot of people say that the government, we have to get them off, we have to get the government off of this, and we have to get the real economy going. And I guess it is a fine line, but if we had a situation where the economy wasn't ready to go and all these programs got withdrawn, what would you think would be the outcome to financial markets?
Well, part of why this is so much unprecedented stimulus this time, in addition to the size of the pandemic, is the amount of debt that was in the system, right? So we already had, going into this, we had record debt to GDP. If you look at all debts combined in the U.S., it was about 350% of GDP. So that includes government debt, corporate debt, household debt, and then we've also had, in modern times, what has been very high wealth concentration compared to how it's been over the last several decades. So we had a very fragile kind of environment going into this, which is why it's a really open question to see how they're going to be able to pull back some of the stimulus, given how dependent markets and the economy are on it. And that's kind of my big thesis at the moment, is that I think if they try to pull it back, you're going to get more sell-offs. You're going to get potentially more civil unrest, and especially with an election coming up, that's challenging. So my base case is that they're probably going to try to extend some of these programs later this year, and Congress is already talking about that. So it kind of comes down to which parts of the program are they going to extend, because there's some partisan differences about what parts they want to emphasize or fix next time.
Right. Now you mentioned debt, so let's talk and explore that a little bit. And one of the things that we probably have been surprised about is the fact that the government was willing to take this much debt. As you mentioned, the fiscal programs were unprecedented, and the amount of debt outstanding is gone way up, especially for the government. Why don't we talk about MMT and the ramifications of this kind of realization that the government can spend this money without really anything happening over the short run, and whether you think that this is a changing moment for society as we realize that what we thought governments can and can't do is kind of flipped on its head.
Sure. So a big comparison I've been making is that in many ways, the 2010s and the 2020s mirror what happened in the 1930s and 1940s. So in the late 1920s, we had that big debt bubble that led to the Great Depression. And that was, it was mostly a private debt bubble. So federal debt was pretty low as a percentage of GDP, and most of that debt was in the private sector. So the 1930s saw the outcome of what happens when you kind of unwind that private debt bubble. And then in the 1940s, that's when, due to World War II, we had unprecedented fiscal spending, and we had federal debt to GDP go up to very high levels, over 100% of GDP. And by then, the private debt bubble had been worked off, but we had very high federal debts and deficits. And back then, the way they financed that was they didn't call it, but it was QE. They basically were the Federal Reserve partnered very closely with the Treasury in what we might even call MMT, but it was like wartime MMT. So
Right.
they capped Treasury yields at 2.5% or below, and they pretty much printed all dollars needed to buy treasuries as needed to maintain those pegs. So even though you had periods in the 1940s where inflation spiked in the double digits, they still held the treasury yield at 2.5% or below artificially. So if you look over the course of the 1940s, treasuries lost on a real basis, even though they made money nominally. They underperformed inflation, and they underperformed many other assets in that very kind of, it was a more inflationary MMT-like environment because of all the fiscal spending. And of course, there were other factors that are different from today. There was more rapid demographics. There was, shortages in certain materials. So if you fast forward to this time, the 2010s in many ways were the unwinding of a private debt bubble. So we had household debt go down as a percentage of GDP. Corporate debt is, not really deleveraged, but as we go into the 2020s, a lot of the excess is now also on the federal side. So prior to the last recession, federal debt to GDP was 60 something percent, and now we went into this one at 106%, and we're already in the early stage of 2020 at over 120% federal debt to GDP. And so the deficits look a lot like they looked like in the early 1940s, but instead of spending on a war, they're spending on the pandemic kind of employment and business response they're trying to do. And once again, we're seeing the Federal Reserve work very closely with the Treasury by basically, buying all the treasuries they're issuing through the primary dealer banks, and even by doing some of these controversial programs like, the special purpose vehicle they set up to buy, corporate bonds and assets like that.
So if we did have a situation where this resembled the 1940s, what would be the asset class, and how would it best perform? What would be the best performing asset class, and how would investors protect themselves?
In the 1940s, mostly it was inflation hedges that did very well, right? So gold was pegged, so that one couldn't move, but silver did very well, and gold probably would have done well if it wasn't pegged. And then real estate did pretty well, and equities did well. Bonds were what did very poorly in real terms in that decade. Now it's a little bit different in this period because in the 1940s stocks were cheap, and now they're expensive, right? So they don't have the valuation tailwind that they had last time. Same thing goes for real estate, right? So more likely, in my opinion, that we're going to see the 2020s end up being a pretty good period for precious metals and potentially for other commodities as well.
Okay, that's fascinating stuff. Now let's. A lot of these kind of policies are. You mentioned MMT and they're MMT-like and wartime MMT. I think that's a great line. Have you had a chance, to read Stephanie Kelton's book yet?
No, I haven't checked it out.
Yeah, so it's getting all the stir, and I know a lot of people are. It seems to evoke a lot of strong feelings in people. I just was wondering what your impressions about MMT in general are.
One of the risks, I think, is when MMT turns permanent for structural reasons rather than in response to crises. So, one thing I've been monitoring is that so in the 1940s, there's a very specific catalyst for why they were getting so much debt, right? It was to win a war. And like I said, by the 1940s, private debt had pretty much been worked away. So there were defaults, there was currency devaluations. So for a variety of reasons, private debt to GDP was pretty low, and it was mostly on the federal side. Uh, we find ourselves in a period now where private debt and federal debt are both pretty high as a percentage of GDP. And a lot of it is structural reasons related to demographics. So we started to see, historically, the deficits as a percentage of GDP rise during recessions and then they shrink during boom times. But starting, in 2016, 2017, 2018, we started to see the deficit rise as a percentage of GDP, even though we were still in, a bull market. So of course, when we had this recession, that blew out huge. So we went into this with 5% of GDP deficits, and now it's 20% or so this year, which is hasn't been seen since World War II. So I think a big risk factor this time around is that they're kind of tackling a federal debt bubble and a private debt bubble at the same time, which has never really been done before. And a lot of it is demographic driven, and so a lot of that ongoing treasury issuance is very likely to be monetized. So it's going to be a very interesting time to see how this plays out in the 2020s. It's not quite as clean as it was in many ways in those prior decades.
Is that why you're kind of friendly to the precious metals? Because ultimately, that's going to be the asset class you think that's going to protect you the most.
I believe so, because a significant reason is that when you do yield curve control, if you lock yields, and they're already talking about this, that's actually another similarity to the 1940s, is that back in 2019, the Federal Reserve started talking about yield curve control. And then in some of their recent meeting minutes, they talked about it again in response to all of this treasury issuance. So if they end up doing that program where they're creating dollars to buy treasuries that are issued, and if they then lock treasury yields, below the inflation rate over, say, the next 5 years or so, that's an environment of sharply negative real yields, which tends to be pretty good for precious metals.
Right. I'm actually confused by the idea that we have to do yield curve control already. You look at the 10-year note, and it's risen from 25 basis points to 80 basis points, and yet everyone's already screaming that we should be locking in the yield curve. Don't you think it's going to take a lot more pain before they actually go and institute one of those policies?
I think it'll take more pain to do formal yield curve control because they are low, as you pointed out. But I would point out that over the past 6 to 9 months, ever since we had that repo spike back in September 2019,
right,
the Federal Reserve has accumulated about as many treasuries as has been issued since then. So that's what yields have done with the Federal Reserve as almost the sole buyer of treasuries. So there's been trading, of course, along the edges, especially in the long duration. So that's been very market driven, but that's what yields are doing when the Federal Reserve is buying trillions of them. So
right.
In many ways, already doing informal yield curve control by taking some of that excess off the market so that the market can then price kind of a smaller batch of treasuries. And if you look back specifically what happened in March, so during the early part of the equity sell-off, bonds outperformed, right? So yields went down sharply. People made a lot of money in the long end of the treasury curve. But then the treasury market started selling off sharply, and it became illiquid, and bid-ask spreads just blew out. And we had a very sharp, a doubling of yields in kind of mid-March. And that's when the Federal Reserve, they started citing that in their press releases for some of their programs. and they started pointing out that the treasury market's not functioning, it's illiquid. So they started buying $75 billion a day in treasuries. And that's what helped push the yields back down from that spike. And then they've been able to taper that, and let the market kind of take over since then. So in my view, they're already doing soft yield curve control by buying so many treasuries and then being willing to ramp that up if we do get illiquid markets or, a sell-off.
Okay, fascinating stuff. What is your forecast for the U.S. dollar?
So over the past couple of years, it's been a big theme of mine. So I release like an annual report every year. And in 2018 and early 2019, I was neutral on the dollar and I was more bearish on the euro. So I ranked the dollar higher than the euro in that report. But when we had that repo crisis in September 2019, starting in early October, I turned more bearish on the dollar from a longer term point of view because it represented a shift of the U.S. going from having among the tightest monetary policy in the world to having among the loosest monetary policy in the world. So back then, we were doing quantitative tightening. We had higher rates. But since then, even though we still have higher rates than many developed countries, even though we're just simply because we're not negative or not, but in terms of the speed at which we're printing money is higher than Japan, is higher than Europe at the moment. So if you look at, say, year-to-date balance sheet increase among the central banks, the U.S. is leading the way. And in terms of, same is true for broad money supply and other measures of liquidity. So we've seen that more bullish trend turn into somewhat of a sideways trend. Now, of course, we had the very volatile period in March when we had that dollar spike up to a dollar index of about 103, because that was, we had the dollar shortage and we had the Federal Reserve launch all these credit liquidity swaps and other methods to try to contain the dollar spike. So going forward, I think whenever this ties back into the view of, everything's kind of tied to fiscal. So whenever we have these periods where the federal government tries to pull back fiscal, we're likely to, see more risk in equities and, kind of sell off in risk assets, and we risk having another dollar spike. And whenever they end up being relenting and giving some of that fiscal back, that's when we're likely to see, ongoing dollar declines.
So some of the FinTwit community and hedge funds are famously, very bullish on the U.S. dollar. They think we're going to have a deflationary collapse and it's inevitable. What would be your pushback to their kind of theory?
Main way I look at it is that left to its own devices in a vacuum, we have a very deflationary situation, right? So we have, we have all this debt overhang. We have a demographics problem. We have, technology is inherently deflationary. But pushing back on all of that is all this fiscal and monetary response, right? So, we had this huge economic shock. So they responded by, printing money, sending out checks, sending out extra unemployment checks, basically throwing an unprecedented amount of money at the situation. And the way I view it is that, throughout history, there's almost never been an economic regime with fiat money that failed due to unwillingness to print, right? You almost never have the printing press and then decide not to use it, right? So it almost always, errs in the other direction where they overprint. So I think when you fully take into account policy response, central bank debt monetization, all the fiscal spending that we're likely to see for the next several years, I think that's a very big counter trend to the deflationary pressure. And if you look back in the previous crisis, they had elevated deficits for many years after that crisis just to get back to the baseline. And we're starting from a deeper level this time with larger deficits and a worse unemployment situation.
Right. I think that's a great point. I always say that no country's ever, no financial economies ever collapsed because of deflation, but I can name lots that have collapsed because of inflation. And you said you don't know. Sorry, you said you didn't know that many that had ever collapsed because of deflation. Do you know of any?
Not offhand, no. I know of a couple. There's been a few instances where countries have defaulted federally, at the sovereign level on their own currency. But even that's rare. But that's happened. But yeah, I've never really heard of it.
Which would be kind of a deflationary default, but instead of inflating it away. You're correct. But that would be, I guess, Russia did it, and then
that's the example I'm primarily thinking of. Yeah.
Right, but on the whole, generally, if you have the power of the printing press, people use it.
Yes. And right now, because the treasury market is kind of at the forefront, right? So when we had this dollar spike, when we had this kind of big deflationary shock in March, the treasury market became illiquid at a time when they wanted to do record issuance. So that forced the Fed to step in and basically backstop it.
So, do you have a theory as to why the traditional, finance community is always erring on this way of saying stocks are overvalued, they got to go way down, and they seem to perpetually be bearish, and that the U.S. dollar's got to go up? Like, why? What drives those people to always take the kind of deflationary collapse view?
I think because that's what a lot of the data that shows in theory, right? So if you take out policy response, people are often surprised by the magnitude of policy response, right? So if you take out the factor policy response, a lot of that looks logical to see kind of just, okay, if we have all this in motion, there's so much debt in the system, all this can do is collapse. It's just we kind of they look at it and forecast that's going to happen. But because countries do their best to avoid that from happening, right? And when they control their own currency, they can change the denominator rather than just letting the numerator take effect. So if there's too much debt in the system relative to how much money's in the system, they can go ahead and skyrocket the amount of money in the system just by helicopter checks and whatever they want to do if they can agree on it. And that has ramifications down the line, right? So I'm expecting higher inflation levels in the 2020s. I think some of these programs, especially the buying of corporate bonds, is opening up all sorts of moral hazards, right? But it's so rather than moralizing about it, it's just realizing that historically governments will do whatever they have to avoid a deflationary collapse and push it instead towards the more inflationary outcome.
That's you're talking my sort of language there, Lyn. I love that kind of chat. So as thinking about this, you're partial to to gold and silver and the precious metals, and obviously you think that you should probably avoid bonds. Is there any other trades that you have that you kind of are recommending or ideas to look at?
So this last chart here that you brought up is something I've been tracking very closely lately because we're at kind of a decision point about it. So it's the S&P 500 equal weight index divided by the S&P 500, the normal one, the market weight version. And if you look back, for the past several decades, the equal weight large caps over the long run have outperformed market weight. And, there's a variety of potential reasons for it. History doesn't necessarily say what's going to happen in the future, so we don't know what's going to happen in the future. But the equal weight version tends to have more of a value skew because you're constantly rebalancing back into buying what's cheap out of what kind of recently did well. And what I find interesting about this ratio is that it tends to have these big volatile periods during recessions. So at the end of a economic cycle, the market leaders tend to get even further ahead, right? So we see a decline in this ratio, which means that the market weight version is outperforming the equal weight version. Which means that the version that has more weighted towards the mega caps is outperforming the equal version. So in all these, the past three recessions, and then again in this recession, we've seen this big drop where we've had this kind of concentration in the mega caps. But historically, that tends to reverse pretty sharply. And then coming out of it, if you end up having a recovery, the equal weight tends to lead the way more. So since March, we've had a consolidation in this ratio where we had this big decline. With everyone kind of buying the big tech stocks, which are more immune to the pandemic. And then we've had this sideways pattern. And we started to get a breakout with this big recent rally, and now we kind of pulled back. So we're kind of back in this consolidation phase. So I'm looking at this ratio a lot to measure kind of the health of the market and to see if what we're getting is more of a sustained reflationary breakout rather than a continued consolidation in the mega caps, because especially when people look at market valuations, like you mentioned before, how expensive stocks were, and a lot of people are concerned about that. A lot of it really comes down to individual sectors. So the big tech stocks are in many ways are very expensive, and like one of the ones I've been highlighting lately is Apple, which hasn't really grown too much in the past 5 years, but its valuation expanded dramatically in the past 5 years because people started just giving it more of a valuation premium. They liked it for a variety of reasons. They felt safe in it. It shifted more towards services, so it got a little bit more of like the software multiple rather than just a hardware multiple. So, big thing I'm looking for now is if some of these more reflationary, more equal weight sectors tend to start taking the lead from here, which would be indicative of a more reflationary outcome, or if we're still kind of in this consolidation pattern.
Well, that's great. And so for those who want to follow it along at home, there is an actual equal weight S&P 500 ETF. Its symbol is RSP, Robert Sam Paul. So Lyn, thank you so much for being with us. Why don't you tell people where they can find more about the services you offer, or they can find you on Twitter? Give us the kind of the 9 yards about yourself.
Sure. So my main website is lynalden.com. And then I'm also, so I have a lot of free content there, and I also have a research platform. And then I'm on Twitter at Lyn Alden Contact.
That's awesome. So it's LYNALDEN.com. Great. It's been a pleasure having you on. Thanks for taking the time.
Yeah, thank you.
Okay, Lena, how you doing?
Oh, I'm great. I actually got some beers.
Nice.
Yeah.
Patrick deserves a big round of applause. He went around and got us all beers. Drove it around Toronto.
He didn't want to get drunk by himself anymore.
It was the logistics, right? Because in the end, we had sponsored beers, but we had no way of distributing them accurately to the whole team. And so we've been like, last week when Lena, what were you drinking last week? It's like tap water or something. What was?
That was like a few episodes ago. I don't even remember what I was. I think I was drinking rum and Coke. Maybe.
I said this has to stop. This has to stop. We have to go back to our long-standing Huddle tradition and get the sponsor beers back in rotation.
That's
so,
right.
Lena, what are we drinking?
We are drinking Blood Orange Sour from Junction Brewery from Toronto.
Nice.
Oh, so this is a super refreshing red orange sour with a light tartness infused with natural blood orange. Oh, I'm so excited.
Oh, this is delicious.
Do you know what? It's actually not as bad as I was expecting. It's actually pretty good.
It tastes.
Thank you.
It kind of tastes like a mimosa, but with beer instead of champagne. Does that make sense?
I don't know if it's
bad?
just too long in quarantine, but I actually like this sour.
Thank you.
This is a good sour.
It's there we go. They like it. All right, Kev, do your little whatever disclaimer
Legal
we
stuff.
have to do. Yeah.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include irritable Dorsey syndrome, the Zoom booms. Patrick, make sure you're on mute for those. Or you might just find that everything hurts. I kind of like that last one, actually.
I've got that case of that. All right. So let's go on.
Dahlia Capital is an independent asset manager with an experienced team focused on the equity and corporate debt markets of Latin America. The founding partners of the company work together in renowned financial institutions and are combining their complementary knowledge with more than 15 years of experience in the market. It's our pleasure to welcome to the show Felipe and Jose. Welcome to the show, guys.
Hey, how are you doing?
It's good. It's great to have you. You know what? I'm looking forward to this. I've long thought that Brazilians are among the two nicest people in the world, the other being Irish. The Brazilian and the Irish are the two nicest people.
It's very hard to compete with the Irish.
It is tough to compete with the Irish, no kidding. What did you say, Felipe?
It's Felipe here. What about the Canadians?
Oh, the Canadians, we're not that nice. We're we're not that nice. We're not that nice. Nothing compared to the Irish and the Brazilians. So let's talk about a little bit what's going on in Brazil. You know, a lot of people don't probably give Brazil the attention that it deserves, given the size of its economy. What are your thoughts about it right here, and is it an investment opportunity?
We think there is a huge revolution happening here in local markets due to a very profound change in the economic policy mix. So the interest rates fell from almost 15% a year to approximately 2%. So it changes everything. It changes the way people should do their savings here in Brazil after almost 30 years of very, very high interest rates. This chart here, it helps to illustrate this situation. As you can see in blue, from 2002 to 2015, it's the Brazilian stock market index in local currency terms. And in yellow, it's our currency, the Brazilian real against the dollar. They had a very, very close relationship during this period. When the stock market goes up, the currency goes up, and when the stock market goes down, the currency goes down. But from 2016 onwards, they started to follow very different paths. And when we see this kind of gap during so long time here at Dahlia, we have to ask, what's going on? And in our opinion, the answer is related with the economic policy mix. From 2002 to 2015, Brazil had a very, very loose fiscal situation and a very, very tight monetary situation. We had the highest real interest rates in the world, approximately 6 to 7% real rates during a very long period, maybe 20 years. In 2016, the economic policy mix started to change. We changed it to a very loose monetary and a very tight fiscal. The interest rates due to that they fell from 15 to, we believe the Brazilian Central Bank will cut rates next week to 2%. And it happened in a very, very short period of time. It helps to explain this huge gap that we see in the last 3 to 4 years between the local stock market index and the currency. We have this kind of trade here since day one at Dahlia. We are long dollar against reais and long the stock market. And it was very profitable during this period. And up to today, we still have this trade. So we think it's interesting to highlight this change in the economic policy mix and the impacts that it causes in the way people should do their savings.
Right. So let's grab Felipe into this conversation. Why do you think the policy changed in 2016 that relied more on tamping down the fiscal and more on monetary?
Well, Kevin, the explanation is quite simple, right? Because essentially Brazil got bust. So we essentially spent all our money, and the government was going bankrupt. The private sector was going bankrupt. The families were over-leveraged. So, there was essentially no money. So there was no money anymore to spend. When you look at the tax rate in Brazil, we are still one of the highest in the world. So we could not increase more taxes to generate fiscal surplus to spend more. Whenever that happened, essentially we were forced to change the policy mix. We were forced to go from a loose fiscal policy to a tight fiscal policy. And because of that, interest rates fell significantly. So it's the first time that we see, in our lives that we're going to have probably negative real interest rates in Brazil. That's something that only 1 or 2 years ago was unthinkable of. So to us, the essential change in Brazil was that we were forced to change because we ran out of money.
Right. And so, Jose, in terms of this chart you had in terms of the stock market going up, do you think without a kind of decline in your currency that the stock market wouldn't have gone up? Was it basically just going up in nominal terms and real terms going sideways?
It's going up even in real terms. We are seeing a mostly benign devaluation here in Brazil. It helps most of our companies. Due to the very high interest rates in the past, Brazil used it to have a very appreciated currency. It was very hard to our companies locally compete internationally, even with competing imports. So the last time it happened here in Brazil, it was in 1999 when we had a pegged currency and the pegged broke. So it helps our economy. It helps the stock market.
Right. And so, Felipe, in terms of, if you get a situation where your currency actually starts to go up again, do you think that we can get a situation where the stock market also continues to rally and this relationship between the two gets severed?
Yeah, we think so. What we're probably going through, Kevin, is just an adjustment on the currency, right? So we had this policy mix that we had very high interest rates and an appreciated currency and a challenging stock market, to a policy mix that we're going to have a very low level of interest rates, a more depreciated currency, and the stock market could respond to that. So after we make these adjustment on the currency, and we're probably already gone through that, we're going to have a more kind of benign depreciation of the currency. The changes are not going to be so strong as we saw recently. We can see with a more stable currency, the stock market continuing to go up. One of the things that I would like to highlight, though, is, Patrick, if you could turn to the next slide, it shows that the Brazilians overall, they don't own equities. So that this chart, the blue line shows what is the total size of the mutual fund industry in Brazil. That's about 5 trillion reais, about $1 trillion now. And the yellow line shows the amount of that allocated to equities. You can see that back in 2008, this number was close to 20%, and now it's close to 12%. When you look at the Brazilians that have a broker account, it's less than 1% of the population, and that compares to 30% of the population in the US. So essentially what's going to happen is that Brazilians are going to be forced to buy equities, just because if you have 20 years of interest rates of 7 or 8% in real terms, you just don't bother buying equities, right? So you just sit on a pile of cash and wait, and just wait for the magic of compounding interest rates to work for you.
Got it. So when you look at Brazil from a fundamental basis and you compare it to other kind of similar countries, are you guys cheap, expensive, or where do you stand in terms of valuation?
Yeah, valuation right now, it's hard to say, Kevin, because we don't know where earnings are going to be this or next year, right? But right before the crisis, when we were looking at a 2-year PE multiple, we were essentially trading pretty much in line with historical leverages. When we look across emerging markets, or specifically within Latin America, everyone was kind of trading in the same range. Mexico was trading a little bit lower. Chile was trading also a little bit lower, but there was not a big discrepancy. So I think that we were trading pretty much in line with historical leverages. But for the first time, we have this change in policy mix, and interest rates have never been this low. And again, we have to see this shift of people moving out of the fixed income going to equities, which my former colleague from Merrill Lynch, Michael Houghton, would call the great rotation, right?
Right. So you guys have not experienced the TINA. There is no alternative because there was an alternative previously. And so for the first time, you're stuff with the actual negative real rates. The argument is that Brazilian equities are headed to, upwards from here.
Yeah, we still haven't had our Tina moment, Kevin. We're waiting anxiously for that.
You're waiting for Tina to show up, and she's finally showing up. So, right. One of the reasons that Tina's showing up isn't you have these low rates is because of the virus and the corona crisis that's engulfed the world. Can you talk a little bit about how Brazil is stacking up versus the rest of the world, and whether you worry about the implications of whether it's controllable in your society?
Brazil is taking a little bit longer than the rest of the world to open. Right. Brazil is a very big country, but we believe that we will open very soon, maybe in the next few weeks. But when you look at the investment consequences, with this kind of interest rates that we have now, And with this kind of positioning, as Brazilians' positions in equities are very low, even if it takes 1 month more or 2 months more, of course it's bad, but the time is helping the positions. The timing helps the bullish positions in stocks, in our opinion.
So basically you're not worried about the kind of virus getting out of control in Brazil because of individual specific Brazilian issues and having trouble with that. It's not something that's on your radar in terms of any more worries at Brazil than the rest of the world.
Yeah, we keep looking at the data, Kevin, and what we have seen over the last few weeks is that when we look at death rates, and in the end, this is kind of the key number we're looking at because Brazil hasn't done a lot of testing. Death rates have been relatively stable over the last few weeks. When we compare that to other countries, obviously we are doing a little bit worse than other countries, but our peak levels, if this is the peak, just to give a comparison, this is essentially going to be the same peak level that you guys had in Canada a few months ago. Okay, which is way better than US and way better than other countries in Europe. There's been some kind of flattening of the curve, but the thing that we're still that we're also looking forward to is seeing these death rates or death tolls coming down.
Right. And so is that partly due to demographics in that I'm assuming your demographics are better than much of the regular kind of Western developed world?
Yeah, it's a younger economy, a younger population. And it was summer here in Brazil as well, right? So we think that the combination of these two factors were essentially helped to flatten the curve. The concerns that we have now is that we're going to the winter next month. The economy is still very informal. People need to go out to make a living. So people, even though we are kind of in a lockdown, people are already getting out, right? Because they have to make money.
I get it. So you're worried about the kind of the fall, but having said that, you still think that the monetary situation and fiscal situation will overwhelm any kind of negative worries that you have in terms of the virus.
Exactly. So there's a lot of people that are concerned with the fiscal situation in Brazil because Brazil's debt to the GDP is going to close to 100% over the next few years. But to us, there's a significant difference if you go to that scenario with interest rates of 15%, and it's a totally different ball game if interest rates are at 2%. Again, this is also a concern that we have. But as we are believers of the lower for longer on the rate side, we are less concerned with the worsening of the fiscal situation in Brazil.
Right. Now, the other thing that Brazil is interesting is that you both sell to the United States and to China. And I was wondering whether you could address the relationship that's deteriorating between those two countries within themselves and how Brazil might stand to benefit.
Yeah, historically, when you look at geopolitical terms, Brazil has been more of a neutral country than anything else, right? And we are essentially commodity exporters, right? So to us, it really doesn't matter if we're selling soybeans to the US or China, if we're selling iron ore to Europe or to China or any other place. There's always going to be a market for Brazilian products because they are essentially commodities, right? One of the issues that we are looking at that could create some attrition is on the tax side. So, for example, there is all this discussion of the implementation of 5G in Brazil and what kind of technology the country is going to adopt. And so this could create some kind of a concern if we go hallway way or if we go other way, right? So I think that we're still discussing that.
What worries that the United States would kind of punish you for that if you chose the Huawei?
We don't believe so much on the punishment side. But again, I think that if we have to look at the different alternatives and see what could be the different implications for the country. One of the important things to keep in mind is that our president, Bolsonaro, is very much aligned with President Trump.
Okay.
So from that perspective, Brazil and the US have been pretty close.
I get it. I actually saw, I don't know, did you guys see the John Oliver piece on him? Do you know who John Oliver is?
No, I don't know him.
Oh, okay.
Kevin.
John Oliver is a comedian, and he had a huge piece on your president. And
I think I saw that. Yeah, you're right. It's hilarious.
It was. Well, I don't know. He also says bad things about Canadians, so he just likes taking pot shots at everybody. So. Anyway, so now in terms of the global economy, there's no doubt that the slowdown from the coronavirus, affected the commodity countries worse than the rest of the world, like Australia, Canada, and Brazil. I would put put us all in the same kind of boat. Do you think, from a kind of global perspective, that we've turned the corner and you're optimistic about global growth going forward? And is that also part of your bullish scenario?
Yes. We think the governments, they have the right mindset. It's very hard to calculate the adequate amount of stimulus right now. But if they have to choose between more or less, we think they will choose to do more. Especially in China, we started to see some signals in the last few weeks regarding credit impulse and regarding China M1. And next year, 2021 and 2022, they are very important years for President Xi. They will have the anniversary of the Communist Party and the re-election of President Xi in 2022. It is very important for him, in our opinion, to have a strong economy through this period. So we think we will see more stimulus in China, more rate cuts, and it will help commodities, and it will help Brazil will benefit from these movements.
That's fascinating stuff. I had actually forgotten about that. Those two important dates. They are very important in China. Now, you mentioned, Jose, that you saw the credit impulse in China already, and you're seeing it. Where are you seeing that? Like, is it from your side or from their side? Is it their data you're watching or your data?
Just one point. This call regarding those two dates, 2021 and 2022 for China, we read in one of your reports. It was actually it was your call.
I think I got it from the Felix Zulauf. I think I was the original one who brought that to my attention, and it is important dates. China, it is important, and it's probably never been more important that they get their economy going. So I agree with you that they are going to do everything they can to stimulate it. But are you already seeing that stimulation? And that's what I'm most curious of. Are you already seeing that stimulation coming through?
Yes, we have some positive signals right now. We like to follow the credit impulse. We follow it through Bloomberg. And in our opinion, it's in a stimulative territory right now. We are waiting for the confirmation from China M1. I think it was this week, it went up a little bit, almost at 7%. We think it may go to maybe 9, 10 in the next few months. And if it happens, it would be very positive, in our opinion. We are following it very closely.
Right, because you guys are very tied to China. In some ways, you guys are in a great situation because you have both the ability to sell to China and the ability to sell to the U.S. You're selling to the two superpowers. You're like Switzerland. Now, Felipe, you got this one chart. You got the Brazilian real versus value over growth. Why don't you talk to us about that chart, what you're seeing there?
Okay, so in this chart, Kevin, so the point that we're trying to make is that whatever happened to the Brazilian currency over the last few months has really nothing to do with our country specifically, right? So in the end, what's going on in Brazil is just a big global trade. So when you look at these value over growth, it's essentially small cap value against the Nasdaq. And you can see clearly there's a significant relationship between that and the local currency, right? Because we have these, when we talk to people here in Brazil, we have this home bias of always trying to figure out what's going on in Brazil to explain the changes or the movements of the currency. But what's really going on is this big trade, to going the money chasing growth and the money chasing the dollar that's really driving, or that really drove our currency to a much weaker level than we had, in the last few months.
Right. So when we talk about, you guys are global investors and you talk to a lot of different people and you keep yourself abreast of information all over the world. And yet I know as a Canadian, I probably don't know about as much about Brazil as I should. And when you go and kind of tell your story, what do you find are kind of the biggest surprise areas? Like, what are people like, wow, I didn't know that. Like, that's fascinating. And what's holding you back from that story getting out there even more?
So I think that when we tell the Brazilian story, I think that the most interesting point is this change in the local interest rates, right? And how this changes everything. Because as we saw in the previous chart, there's a significant increase or significant potential for the retail investors in Brazil to go or to shift to equities. There's going to be a massive boom to capital markets in Brazil. There's clearly going on a Robin Hood effect here with retail investors buying a lot, or we saw a lot of that happening over the last a few weeks, right? There are what we can say that are always a Charles Schwab effect with a company called XP that's just giving access to everyone to the stock market. So it's much easier and cheaper for people to trade and for people to have access to funds like ourselves. So because historically Brazilians, again, as we said, they didn't have to bother, right? So they were just putting their money in the fixed income, earning 7 or 8% of real interest rates per year, and then it's fine. There was essentially no need for financial education for the population. And what the other thing that I think that people underestimate is that we think that there's close to 1.5 trillion dollars, $1.5 trillion sitting in fixed income in Brazil, and that used to earn 7 or 8% real rates, and now it's earning negative real rates.
Right.
Something has to change here. And the question that we do ask ourselves every day is, okay, so where is this money going to?
And so far, have you seen it moving? Like, is it going out of fixed income, or is it being something that's just been very slow so far?
It's been very slow, but as I said, we're seeing this Robin Hood effect. People are starting to trade and buy more equities. And the other thing that people are going to do, they're just going to move the money away from the country, right? So people are going to have to buy dollars. You would be surprised, Kevin, of how much dollars people own here in Brazil. It's essentially zero.
Okay, but isn't that kind of negative towards the real in terms of its value? Like, are you as optimistic on the currency as you are on the stock market, or not? No, not that.
No,
way.
We are long the stock market and short the currency.
Okay, I get it.
That
and
makes
you
sense.
I completely get it. So for those who are playing, want to trade this, don't go just buy the ETF that has a real, because you might find that the situation is that the real goes down and you lose there, but you win on the stock market. So you almost want to do it through futures if you're a non-Brazilian.
Yeah. There is another interesting data. During this crisis in the last few months, the local equity funding industry here in Brazil, they didn't saw withdrawals. It was zero, even during one of the worst crises ever. This is, in our opinion, it's a reflection of very low interest rates and the shift it causes in Brazilian savings.
Well, that's fascinating stuff. Well, listen, guys, I'm going to make the conversation in terms of finance to bring it to a head, but let's talk a little bit about Brazil. You're not going to have your famous parties on the street anymore, are you?
No, Brazilians like Carnival. At some point, we're going to resume that. We were lucky enough that the Corona crisis hit the country right after Carnival and not before.
Oh, okay.
So that Carnival was in February, so we were fine to go out and have some fun.
So why don't you tell us why don't you both come see if you can come up with one fact about Brazil that you think that people would be astonished or interested in knowing? Like for example, something about your sports, or we can talk sports. What about your soccer team? You guys actually pretty good soccer players, I take it.
Yeah, of course. We are trying to create a soccer league here, among the different hedge funds in Brazil, because we're sure that Dahlia would, beat everyone else.
So
Jose is a great striker. It's unbelievable. He's got another talent.
So, Felipe, you're laughing about this, but in Canada, the finance community actually has a hockey league that we do in terms of all the different firms go. And my brother actually played professional hockey in the NHL, and he used to get recruited by a hedge fund to go play for him. And they would take kind of ringers and they would put them on the payroll so that they would win this hockey tournament.
We have some soccer players that invest here with us. We'll call them to join us. Our team.
That's right. So that's how serious we take hockey. But I think you guys take soccer just as seriously.
Yes, we do. So we are big fans of the sport. We're big supporters of the national team, and so we're just looking forward to see if there's going to be a World Cup 2 years from now. We hope so.
Well, I hope so too. Listen, guys, it's been a pleasure having you on. It's really great to meet you, and I look forward to doing this in person over some drinks someday.
Yeah, absolutely. We too. So we're looking forward to visiting you both in Toronto next time.
That's right. Just make sure you come in the summer, because I don't think you'll like our winters.
Thank you very much.
Well, thanks, Jose.
Right.
Thanks, Felipe.
Thank you. It's been an honor. Thank you.
Okay.
Thanks,
Bye-bye. Okay, Patrick, time for talking charts. I think you got a good one for us.
Yeah,
Lots of things to talk about.
Wow, I take a week off and suddenly everything goes to hell in a handbasket, doesn't it?
That's good for you, buddy.
Yeah, and so it's good for me for sure. So let's start off just talking the S&P 500, because what a monster move. We haven't had that magnitude of a drop since March. Right? Like you have to go, for us to have, from top to bottom within like 24 hours, we were, a little more than 24 hours, but it was like a 250 point drop. And
it came out of nowhere, really. It got a lot of people off guard.
It did. Well, you do have to admit that the bullish enthusiasm was pretty thick, right? It was pretty much that everyone was convinced that you just can't do anything but buy the market. And so usually the market does the role of playing the great humiliator and needs to separate a few people from some money. But life goes on, right? And so anyway, the big drop.
1 second, Patrick, before I just want to interrupt for 1 quick second. What's interesting is that we have now had 4 of the top 25 single-day drops in the market have occurred in 2020.
Mm-hmm.
The number 3, the number 6, and then there's something like the 12th, and now the 25th biggest drop. Well, that was the June 11th, minus almost 7%.
Yeah.
So I find that fascinating.
It's amazing, but that's the nature of the stock market, which is it rises on an escalator and drops on an elevator. I mean, think about this. Like we basically took, we went from May 14th to June 9th, almost a month of advancing, 26 days to rise 469 points. And basically we wiped out 50% of that entire rise in one day.
Yeah.
Right? That's the nature of how the market has always done this. And that's where the art of learning to hedge or take some profits off the table comes to a great benefit at the tail end of these kind of moves. The question is, I'm going to save it for the top 3. We just have to really ask what's next for the markets. But I thought this was a particularly interesting chart, this next one, which is just looking at the FANGs. This is the FANG futures, right? And obviously all of the media hype associated with the fact that the NASDAQ and the FANGs making 52-week highs. It was really interesting to kind of have Lyn talking about the fact of the equal weight versus the market cap weighted and the nature of these large mega cap storylines and how they drive during these periods on the interim, but then there's a rotation. But the fact that these have recovered and made 52-week highs is extraordinary. But with this reversal candle coming in here, is this where this entire trend pauses? Usually one day doesn't make a new trend, but usually market turns start with candles like this. And so watching next week what happens here on the FANGs is going to be really interesting.
And Patrick, is that to qualify for a prairie dog?
Yes. I like one-day prairie dogs, but you know what? To be honest, I guess we can't really call it a prairie dog unless it recedes all the way back down, and
that's right.
Was just
still
pause.
Undetermined whether it's a prairie
still
dog.
Holding at above the February highs, so you can't call it a prairie dog that way. And those are vicious creatures, right? We'll talk about.
Wait, we're gonna save that. Save that.
Yeah, no, I'm saying, but like
shocking information that we've learned about prairie dogs that we'll talk about in the after show.
For sure.
Shocking stuff.
All right. So let's talk about Caterpillar for a second, because they came out, like, I think that over the quarter, they experienced like a third drop in sales, 1/3 of their sales. Just a shocking number. And it's pretty interesting because overall, and this is a testament to liquidity versus fundamentals, because, I mean, more or less, Caterpillar is trading at the same price as it traded through most of 2019. And yet, there's this big, massive economic shock. And really, to be honest, if someone bought this in the middle of 2019, they're break even right now, right?
I guess roughly, approximately, but
it depends on where. But I don't know. Is this a major reversal? Like, that's a little in technical analysis we call that an island top. You just kind of that has almost like a very prairie doggy kind of feel to it, right? It pops to
does have a little bit
a higher high, gaps lower, and leaves that little island up above. Definitely,
islands in the stream.
Yeah, there you go. But now now while Caterpillar's been some crazy stuff, let's get to the really crazy stuff. Hertz. Who would have thought that this going bankrupt company would take so much media, press, and attention? I would have never, right?
But it's hilarious because going bankrupt ended up being a business plan because the stock would explode higher. And it's shocking. Like, so why don't you do your technical kind of mojo, and then I'm going to go and talk.
I have nothing to say other than this is absolutely insane. I mean, the company was almost at zero, and then shoots up to $6 a share when announcing the fact that they're going bankrupt. What's
amazing about this, Patrick, is that all the Robinhooders have gotten into it, and there's often squeezes in these things because of things with CDSs and, people that are long the bond, short the stock, and then they push it and they get bought in. And there's kind of games that are played this way, but this was in another league. And what's the most fascinating part is that the bankruptcy judge has just okayed tonight, like we're taping this Friday night, after the market close, he okayed what is known as an at-the-money offering. So even though this company is bankrupt, they are going to go and issue shares in the marketplace to all the people who want to buy it. It's just like fascinating because this company is bankrupt, and this
so that and what is the company going to do with that money? Are they going to pay off debt holders or
well, so I say it's bankrupt, and the reality is that what's happened is that they're going to get diluted down, and there will be probably some
equity left,
residual value for the equity, and that's the part about this is that just because you're bankrupt doesn't necessarily mean that the equity holders will be zeroed. But often what they are is diluted out to nothing. And, I've gone through these things before, Patrick, where you own some bonds and you know that the equity is worth zero, but you can't short any because the reality is you can't get a borrow or you're going to get bought in. So you just sit there as a bondholder, that's trading at, let's just say, 20 cents or 5 cents on the dollar. And it would be terrific if you could go short all the equity you could. But the reality is that you're going to, as bondholders, are going to own 99.999% of the company. Yeah. And this little sliver that's trading in the market will be eventually kind of diluted to zero. But that won't happen until the reorg goes through. Yeah. And that's what's happening here is that we have a situation where there's actually enough of a bid that the bankruptcy judge has allowed them to go out and hit that bid and basically fill it. So what's going to be fascinating is to see how much they get off before the thing collapses, because it should be.
So the government sends all the Robin Hooders a check for being unemployed, and at zero commission, they allow these guys to go in there and take part in this, so that to basically transfer the money from the government directly to Hertz.
I don't know. It's batshit crazy.
It's
this is like, you know what? Like we were just like, I was laughing. Cuppy and I were chatting about it. He's like, did you ever think you would see something like this? And I said, no, this is just FUBAR. That's all the way you can describe this. FUBAR.
Yeah. It's nuts. It's nuts. All right, let's go to the next chart. Okay, we're going to talk Nikola. This is now. This is one of these SPACs that has gone I mean, we've seen some parabolic moves on SPACs, but this is pretty spectacular, isn't it?
So remember, I think somebody pointed out the other day that ever since we had Jamie Wise and the SPAC research fellow on our show, the SPAC market has gone bananas. And here was an example of something where you could have bought this. Used to trade as VTIQ. I think that in May you could have bought this thing at $12, and and don't forget it's always going to be worth $10 or $10.50 or whatever because of the fact that you could put it back to them. And this thing's gone from $10.50 to it ticked at $96.
Yeah.
Wow, it's absolutely incredible. Just insane. It's nuts. There's no borrow.
It's nice to know that we have that strong of an influence.
Yeah, that's right. It was all us.
It's not just the Cuppy effect, but now
no. So Patrick is being facetious. Obviously, we have nothing to do with this, but it is interesting how some of these SPACs have kind of captured the public or the investing public's imagination, and they're taking them off to levels that are just absolutely obscene. Like, let's just look at the market cap of this thing. Right now, today, it's trading at, I think because it has no revenues, or almost none, and it's trading at a $23 billion market cap.
Wow.
And it's crazy. And listen, for those that are interested in derivatives and the fact that there is some warrants that are trading out there, and just be careful. I want to give everyone a big heads up. There's elements of these warrants that make it so it's very difficult to arbitrage them. And there's this cashless exercise. And so if you are one of these people that's looking into these, don't just go look at the exercise and go, look, this thing's cheap and it's trading below intrinsic. The reality is it's a European exercise and there's a cashless option. It's very complicated. Be careful with that. There might be opportunities.
It's not as simple as...
but it's not as just simple. It's one of those things when you see an arbitrage that's too good to be true, it usually is. Well, this is one of those cases.
Exactly. All right, so let's talk about Boeing because at least what I heard the story was is that there was an announcement that Dan Loeb at Third Point there basically came in and scooped some of this up, and it was like in middle of May when that announcement came out. And just as the stock market just kind of got that middle of May bid and popped, and then Boeing goes ripping from $120 to almost $240 in one fluid motion. Like, talk about, like, this is a big blue chip company. Well, it used to be blue chip, and just to move that kind of percentage in less than a month. Right,
I guess, Patrick, that's the nature of when you're down from 360 down to 100.
Yeah, and it barely 50% retraced, right? Like it just popped above a 50% retracement. But still, that's, I guess, the nature of percentage returns off of those huge lows, right? Like like you take a Vintiv or any of these other energy plays after getting slammed that way, when they're going from $2 to $10, it's like a 500% return, right? But they haven't remotely made back the money they lost. But one way or another, what a move. And what's interesting is the pullback of the last few days also was a 50% retracement. And so typically this is the crossroad moment. Was this a fake out or is this the buy on dip? This is a really interesting moment. If somehow the bulls, like, let's say the whole market has proven that this was just a fake out and the whole market turns back up, and this might be a buy on dip before Boeing heads right back to its highs, 240, 260. It's going to be really interesting. I honestly don't.
Patrick, what is it? I want to make you tell me which one do you think? Which way is it headed?
We're going to save that for our top three, buddy. I'm intentionally being elusive about this because we're going to talk about this a little bit later. All right, but okay. I do want to talk about the VIX though. And it's interesting. The volatility was just narrow. I mean, me and you have had so many debates that volatility. To me, until volatility get back in the 20s, we're not in a bull market. You say there's been periods like 99 that volatility stayed high and yada yada. But the point is that we do have high vol, and finally this break caused this technical breakout, which typically is associated with the beginning of a move. So is this a real breakout in volatility? That's one of the really this should have been actually in a top three. I don't know why I didn't include it. Like, is this a legitimate breakout in volatility? What's your take?
I don't know. I kind of laugh because I see lots of people on Twitter making fun of people that do technical analysis on VIX. And then Chase Taylor, Pinecone Macro, friend of the show. He's like, shows the trend line and then shows where he buys it because of the breakout on the trend line. He goes, works for me. And I was kind of like, he's got a good point. Like, you guys can make fun of him all you want, but if it's working for him, like, so be it.
I mean, Patrick, it is simply a reciprocal of the stock market, right? Because I mean,
it's not though. They're okay. I'm going to push back there. It doesn't necessarily mean it's not the same thing. It is not a reciprocal of the stock market.
We had a 250 fucking point drop on the SPY or the S&P that caused the spike. So don't give me that.
It doesn't need to go together. I will show you.
I know it doesn't have to go together, but it is the typical relationship. It's that volatility increases when the market's dropping. That is the typical go-to. Yes, you can. Right. I'm sure you can identify periods where that has not been the case, but
you
usually
could also a slow drip that's controlled will see lower volatility. At the same time, a manic increase that potentially could have increasing volatility. Anyways, I don't believe in that idea that they have to be kind of inversely correlated, because I think that you could have a situation where you get very volatile stocks exploding to the upside, and therefore in that environment, I actually would like to own volatility.
There you go. So I want to talk about the Dixie. And I'm intentionally doing that because I refuse to put up a chart of the euro because I don't want to goocher any supposed stake trade that might be emergent on this thing. And so we're just going to talk the dollar index. That way I can avoid angering the market gods. And that bit of a reversal after a little measured move to a pretty long-term, I wouldn't say support line, a consolidation place where typically the dollar has spent a very large amount of time consolidating. And obviously this was driven by fiscal and monetary drivers that have moved it. But for most part, this move has played out. And I think that the next move in the dollar will be about what happens next, not so much what's happened backwards. And it'll be really interesting to see whether this was enough dollar selling or whether this is actually the beginning of a new, bigger trend move. I won't lie. I have a really hard time letting go of my dollar bull narrative. I'm still dollar bullish, but you know what? We have to. I have to be objective enough to see that if something's not working, I have to abandon it. But this is really an important line in the sand for me, anyway, for the dollar.
Very wise of you not to mention the euro. And I'm going to actually tell you a story. And tell our listeners a story.
Okay.
About our good friend Cuppy. And so Cuppy and I are talking, and he literally starts to tell me, and I'm going to tell you what day this was. Let me just pull up a chart. It was most likely the 11th or the 10th.
Of June?
And he says to me, oh, that steak that Patrick is going to, he said something to the effect like the stock market something was happening in the stock market. And he says, but at least I'll get my steak from Patrick about the euro. And I was like, oh God, you didn't just do it again. and I was so hopeful that maybe the market gods weren't listening because it was
Cuppy,
like
you don't get it, buddy.
Conversation. It was a private conversation. But obviously, the market gods listen to all conversations. They're omnipotent,
you can't,
of course.
You have to. And he
goochered it again.
And
so you're good.
Did I just goocher it now?
No, you're fine. You're fine. You're fine. You're very humble. You won't even mention it. Cuppy, on the other hand, started counting his chickens again, and he goochered it.
Thanks, Cuppy.
I hope he repents.
Thanks, Cuppy.
I hope he goes to confession or whatever it's going to take to fix that, but he's got to fix it. He's got to stop talking about it. I tried to stop him. I was like, no. And then it was too late.
So the last one we'll talk about, and then we'll move on, is Genius Brands.
Oh,
what a move!
So many of these stories that are just kind of going berserk. You know, their Dave Portnoy specials where he mentions it and everyone gets all excited about it. And it's just a sign of the times that you have these stocks, these small cap stocks that capture this Robin Hood kind of trader's imagination. And they just rip. Like they rip like you've never seen before. There's so many of them, Patrick, out there. It's, there's just every time you turn around, there's something else that's just going bananas. It's just the new reality. And you can sit there and you can.
The stock market has become the new casino, right? Where basically there's no sports to bet on, and everyone can open a commission-free account and play penny.
A lot of the old timers are getting all upset about it and talking about how it's getting so badly.
It's just a reality.
Yeah, and not only that, it's great. More people playing it, volatility, opportunities. Listen, them buying hurts. Dumbest thing I've ever seen in my life. But that doesn't mean that I can't short it because I can't get a borrow, but I can go short calls and stuff and I can trade the crap out of it. It's great opportunities. So don't blame the game. Just go trade it. That's the reality of the situation.
Yeah.
That's my 2 bits of advice.
All right, there we go. Okay. So let's move on, buddy.
Okay, this week in trading history, what do you got for us, Patrick?
Well, we're going to go back to June 10th of 1696 back in England when they issued the proclamation that is known today as the English Great Recoinage of 1696. And it's one of the great monetary events in history. It led to the creation of the infamous British gold standard and the international gold standard, and even embarrassed some wealthy Englishmen. And Kevin, you as a Scotsman yourself, I'm sure that really butters your shortbread, right? It was in the late 1600s, England operated a precious metal monetary system, also known as the specie. Of minted gold and silver coins. However, the system has some serious flaws, which ultimately threaten the very survival of England. And so the first considering these coins were minted manually, no two coins were the same. This resulted in the fine art of coin clipping, or the removal of small pieces of the coin and melting it down and then selling it as bullion on the open market.
It sounds like a Kyle Bass trade. Remember when you bought all those nickels because the nickel was worth more?
I did not hear that, but there you
nickels.
go. That's exactly it. This obviously strained its true value as the metal content did not correspond with its face value. So another shortfall of the species was they've discussed here on the podcast before is that the fluctuating value of the metals in the international markets creates opportunities for arbitrage. And in 1696, England was at war with France, which meant a very volatile metals market. And when the changing of the gold-silver ratio made it worthwhile, opportunists would clip some silver coins, melt it down into bullion, sell it for gold abroad, where the silver fetched a higher price. That gold would then be shipped back to England, where the Royal Mint was paying a higher price, and it would be exchanged for silver coins, and the whole cycle repeated.
Nice. Respect. I like those arbitrageurs. I like it.
This resulted in an extraordinary drain of silver and an oversupply of gold. And so if what I said confused you, just remember that at one time this scheme was described in a Cockney accent. Right, and so it would have been a little harder to understand. So
1 second, Patrick, I gotta interrupt because there's a group on Twitter that's gonna love the fact that you said scheme.
Really,
they love how you say scheme. Say it again.
Really?
Scheme. Yeah. Yeah, there you go. You got it. I know I probably just ruined it for all of them that are listening. But anyways, that's fine.
Scheme.
You keep going your way. You do you, Patrick. You do you.
Okay, so the species also hindered the minds and imaginations of economic thinkers. At the time, the financial instruments were evolving on their own to be more complex, and the coins hindered these operations. Everyone was hung up on bullionism, which was the belief that your wealth was defined by the amount of precious metals in your possession compared to free flow system of trade. And so to top it all off, England also accepted these clipped coins at their face value for tax payments. So this got so bad that at one point, the weight of silver collected in taxes was half of what it should have been.
It's like ripping all your dollar bills.
Yeah, cutting your half. I'm only going to pay my taxes with half of this dollar bill.
Yeah.
You only get the right half. I'm keeping the left half of this bill.
Yeah, I'm going to spend it later.
So this resulted in the lost faith in currency, rising inflation, and posed critical risk in their war against the French. So for England, it was adapt or die. So in response, England formed the Commission. Cue in the Bad Boys music montage here. This Treasury task force had some of the country's most prominent economic thought thinkers, each voicing their own proposals during the debates. And so there was those that favored devaluation and those who advocated the expansion of credit. And then the Royal Mint Master himself, Mr. Big Brains, Sir Isaac Newton, who sought to achieve gold and silver mint price parity. However, it was the suggestion by a prominent philosopher, John Locke, which took hold, where England would demonetize their existing clipped coins and issue new full-weighted coins to replace them. And so essentially, we've seen, I guess, in our time, like some of the bail-ins in Cyprus and all sorts of crazy things. But like literally, they were gonna say, well, or even what happened in India and stuff. They're with the higher denominated bills. Basically, they're saying, well, we're just gonna say all these clipped coins are worthless, and you have to trade them in. And so this created an extraordinary event. And so that started in May 4th of 1696, and these clipped coins were no longer to be legal tender or accepted for tax payments. They basically said, well, you guys have been clipping them, now they're worthless, right? And so this rushed decision suddenly wreaked havoc in the system, and the Royal Mint was woefully unprepared, as they've only printed 15% of the new coins required. And so the recoinage also couldn't account for all the fluctuating metal prices, so arbitrage still ran rampant. As a result, depositors ran the Bank of England and demanded the silver coins. So the bank was forced to stall debt payments, and they couldn't resume any of these payments until like almost 6 months later in October, where they received a loan from the Dutch.
Oh,
right? They had to
with
turn to the Dutch.
Eyes.
Yes. That's the colonel with the beady eyes. Buddy.
Oh, I'm sorry. Yeah. Same conversation, though. Yeah.
Now, to get to the shaming of the Englishmen, at the height of the crisis, it was said that the Duke of Beaufort was famously forced to pay for his lavish dinner by entering his name in the book. Imagine that, Kevin, that a duke himself was using credit, writing an IOU. The shame of it. Can you imagine that?
That'd be terrible. Although, Patrick, you've never gone to a bar and not had any money and just left your name in the book?
No.
Well,
but I'm sure the day is coming. I'm not in any way saying that I'm not capable of that. But I'm not a duke either, though, right? So, so it was in the summer of 1696. England's economy essentially stopped, and the ensuing monetary contraction led to massive unemployment, poverty, and civil unrest. Not that we've ever seen that or any. The crisis ultimately spurred a new era of economies driven by a broad set of financial instruments, including, laid the foundation of fiat money, which was backed by the full faith of the issuing government. And so it really, it's interesting how it sounds a little bit familiar what's going on today. Maybe we're heading down our own little revolution, right, Kev? What do you think?
Yeah, and pretty soon we're going to be leaving our names at the bar.
Well,
just drinking. As
long as they pour the beer,
that is exactly right. Like, I don't see what the big deal was. He got his beer. That's all that's important.
There you go.
By the way, go back to the picture 1 second. Who is
that's Sir Isaac Newton.
Handsome guy. Oh, that's he's a handsome fellow.
Yeah, wasn't he?
Yeah. Okay.
All right.
Thanks for that story, Patrick.
No problem. But let's get Taylor to jump on here. How you doing, Taylor?
Real good. How are you?
I'm all right. So you put together another WTF clip for us this week, and why don't you give us a background here?
1 second before he does, these continue to just be hit out of the park. I think they're terrific. You've gotten yourself a full-time job. Obviously, mine pale in comparison. Pale. These are just awesome, Taylor.
I'm glad. Glad you like them. Yeah.
What do you got for this week?
So, we were talking about what's happening this week, really, and you sent over a clip of CNBC's Kelly Evans breaking down how the Federal Reserve should support the U.S. economy's road to recovery with this guy Bill Lee, and this guy is a really smart guy, head of economics for Citigroup North America, and his job is to give actionable advice about U.S. policy to global clients. So, this guy's got the ear of everybody. Everyone's asking him what they should do, and then he goes on the news and he says this. So, I guess roll the clip.
All right, let's watch.
I'm Bob Slidell. This is my associate, Bob Porter.
What would you say you do here?
We talk about
buying loans and giving more easy loans. What the Fed should start to do would be buy equities the way the Hong Kong Monetary Authority did during the crisis.
Beg your pardon?
Buy a big ETF and support the equity market, allow more IPOs to come on the market, and perhaps buy packages of IPOs in different sectors to encourage a newer, innovative investment.
He's useless.
Gone. Sounds good to me.
It's just batshit crazy, isn't it? What he's saying?
Just print and give. Print and give.
Well, buy equities? The Fed should buy equities? Like, seriously. Anyways,
Oh, come on. Everyone else is doing it. Why shouldn't the Fed?
Oh, God. It's just like, it just drives me nuts. The idea that we think that the Fed should get in there and buy equities is just, it's so dumb. And the fact that he literally got up and
Come on. It's
said,
worked so well. Look at the prices of European and Japanese equities. I mean, raging bull markets for decades, right?
Well, first of all, nobody's buying European equities. Even the ECB won't buy those.
That's true.
But to be fair, Patrick, like the other central banks are buying U.S. equities. Swiss National Bank.
Swiss is buying U.S.
holders.
equities, and then
Yeah.
Japan is buying their own ETFs.
I just think it's absolutely crazy. But anyways, listen, Taylor, terrific, awesome. I loved it. It was really funny. Honestly,
Well
terrific
done.
job. Well
Thank
done, buddy.
you. Yeah, well, looking forward to next week.
All right. So Kev, it's time. Top 3 things to watch next week. But before we do, I wasn't here last week, so why don't you take us through what happened, what you guys were looking for? And
I think I did the world's fastest top 3 ever done.
All right, so do it.
No, I think last time I did.
Yeah, so
Let's go breakdown from here. Now, pull up the charts. Let's have a look.
It didn't, by the way. Hold on. Let me
No,
just
it didn't. But it's not looking good though.
I call bullshit, buddy.
Oh, nice.
In the eye of the beholder. Hold on, let me pull it up here. Oh, sorry.
Actually,
I should have been on the ball and ready for this. But okay, here we go.
Yeah.
So
you're absolutely right. It didn't break down. That was the greatest sign ever when I asked if it would break down.
Yeah. No. This is why it's dangerous. What we're going to be talking about in the top 3 is I don't want to gooch or anything.
Number
right?
3 was, does gold break down? Nada. Did not.
Number
2. Let's go.
So number 2 was the bond auctions.
Oh God, did I goocher this thing? Bonds screamed all week.
Yes.
Yeah.
I'm glad, and you know what? It was because I wasn't here. Like you just took the mic, and you were like, Patrick's not here, so I can be as bond bearish as I want. And you know what? You're paying the price.
I am completely agree. I thought I honestly
look at
thought
that
that the bond auctions would weigh on the market, and they just ate it up like nobody's business.
Yes.
Yeah, it was just like, yes, sir, may I have some more? Like, it was unbelievable.
All right. And number 1 was the FOMC meeting, which didn't disappoint.
No, it didn't disappoint. What was interesting about the FOMC meeting is that once again we had a situation where that proved to be the top for this rally. And if you actually go look at the last time, this happened before as well with the FOMC. You get the big, huge emotional update when he's as bullish and as dovish as can be. And then the next day it rolls over. And that was the top. And so it was the number 1 thing to watch because it ended up being the top in the equity market.
Right.
So at least I got that right.
There you go. All right, so let's get to what we wanted to watch this week. And so this week, the first thing I wanted to just ask is the short-term oil advance finally stalling? And you know, I don't want to say bearish things about oil because once we've seen minus 40, it's kind of hard to be more bearish than what we've already seen rear view mirror, right? And so, but what we do have is, I'm just going to focus on the July contract because I think that big tick lower was just too nasty to include on the chart. But we had basically oil prices get back to levels that were attempting to fill the gap from the OPEC news back in March. And now we're seeing it roll over with the whole kind of everything went a little bit risk off here, and it rolled over. And so now that we've more or less gap filled here, the question I'm asking is that enough for this part of the advance? Now, usually markets will go back, retest lows. I don't think we're going to see a double bottom, but they'll come back, kind of backfill that move, create a basing formation, and inevitably down the road, a bull market could begin off of a base like that. But is this enough for this current advance? That's certainly something I'm watching. Do you have an opinion on that?
I'm probably not as bearish as you on crude oil.
So you're bullish? You think it's just going to go rip higher? What do you mean bearish? I just gave the most unbearish view. I was like, it's not going to go to lower lows, or even
to be honest. You know, I just assumed you were bearish. I'll be honest. There was a takeover deal that I was involved in. There was some news that I'll just be honest. I'm gonna flake on this.
All right. So. Kevin is not as bearish as me. All right, so here we go. Number 2, Kev, this is you, so don't read your emails.
Okay.
The second wave of COVID, it seems to be what at least the media is kind of anchoring on when this market started selling. They kind of use that as their headline anchor. What's your take on all of this?
I don't have a view, but I do think it's something to watch. Because that was, as you mentioned, one of the excuses given for the stock market sell-off yesterday. That's correct, on Thursday. And whether or not it's happening, I don't know. I'm not going to get into it. It incites a lot of political kind of opinions, and it's like very divisive. I don't want to get into that. I'm just saying that we should watch it. We're reaching the point where, given the fact that we've loosened, let's just say, we've reopened the economy in a lot of ways. If we are to get upticks in the amount of COVID kind of infections, this is when we should be starting to see them. So it's important to continue to watch it and monitor it and to see if that second wave comes sooner rather than later.
So my take on this is a little bit different because every fucking person knew that there was a second wave coming. That anyone that knew what COVID is,
I don't know. There's some people think that
no. They're the people that actually did some basic research understand that this is a hammer and dance scenario, and there's going to be ups and downs in the waves of how this comes in and out, and I think that the media is anchoring it off of it more than the stock market is. What I think that if the stock market wasn't down, then the spike in COVID cases would have been irrelevant to the media. The media just needed an excuse as to why the market was down, and it just so happened that there's an uptick in COVID, and that's their anchor. I think that COVID was the reason the liquidity event caused in March happened, but I think that if there's another leg lower in the bear market, it will not be driven by COVID. It's going to be...
So you think that... well, what happens, Patrick, if we get, like, I've seen rumors or speculation at least, that Dallas would have to close? And what if we get more of the society shutting down again?
I feel that the market can brush those things off. I feel that there's a bigger economic consequences to the shutdown that, like a domino effect, creates a negative feedback loop. That if it starts to reflect in the economic data, that's where everyone will realize that this is not as simple as buying the dip, and that could spook the markets. But I don't think that is going to be the headlines of the number of cases. It's going to be driven by over the next couple months as the data starts being revealed as to how bad the economy was hurt by all of this. That's when I think the stock market will potentially start to eat that, if it does. And I'm not saying that's has to be the case. I obviously have a bearish tilt to it, but that is what we're watching for sure. Okay. Anyway, well, do you want to add anything, or can we go?
No,
number
I
one?
have nothing to add.
All right. So number one, risk off or buying opportunity. Obviously, I showed the S&P chart in the talking charts, but this was truly an intermarket move because almost all global equity reversed, and at the same time, dollar ticked up. almost all the risk-on kind of currencies that are sensitive to commodities, like the Canadian dollar had a decisive reversal candle. Aussie dollar pretty much turned very cleanly. Crude oil ticked down. Gasoline turned down. Copper turned down. Well, then had a bearish engulfing candle. Basically, it was a risk-off candle. Now, the thing is, I always say one day does not make a new trend. And this is the key, is that just because that happened on Thursday doesn't mean that everything has to crash from here. But this is such an important puzzle piece to solve. Is this a risk-off moment, or was this just a buy on dip? Because typically we have seen in the past where if this is a buy on dip opportunity, this pullback shouldn't last more than 2-3 days. And when it finishes, the market should cleanly turn up and should be roaring higher by middle to late next week. And if this is risk off, then every rally will fail. And then there's going to be just some form of a liquidity event that's going to slam the market. And that is 100% what you got to watch next week. Which one of these will prevail? I obviously have a little bit of a bearish tilt, but I want to be eyes wide open and see which way it really turns.
I'm going to go with eyes wide shut and just keep my mouth shut. I don't want to Gucci your in my trade, so we won't even mention anything more. It is the number one thing to watch next week.
There you go. All right, let's wrap the show up with some parting words of wisdom, Kev. Why don't you take it from here?
So I thought this was a terrific line. Taylor came up with it, and I thought it's like, I've never heard it before, but it's from the old Blue Eyes himself, Frank Sinatra, the chairman of the board and one of the greatest S&P traders that's ever lived. He says, the best revenge is massive success. I thought that was so wise and so good.
So wise.
So wise. And I hear he tossed around the S&P. It's like nobody's business. He did. You think I'm kidding? I'm not.
That's awesome. That's awesome. All right.
Anyways, okay. Well, that's it for our main show this week. We appreciate you tuning in. We couldn't do the show without you. I'd like to thank Lyn Alden for her terrific macro discussion. And then the guys from Dahlia Capital that dialed in from Brazil. It was great having them. It was a real pleasure. We actually had set up for a dinner that we were going to have with them. They were going to come to Toronto and meet us and go out. And unfortunately, the COVID has put that on hold, and we decided to have them on anyways. And I'm so glad we did, because I don't know about you, Patrick, but I'm going to go out and have a look at that trade, because I'm convinced real rates might send the Brazilian stock market higher.
As long as you hedge that currency, buddy.
That's right. Okay, and if you like something on the show, please share it with your friends. You never know. The bigger our following, the better chance we have at getting old Elon Muskie on here to chat about his $200 million pitch deck to Goldman Sachs. Before we get to the after show, here's where you can find us. You can listen to us on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people listen on YouTube to see the charts and visuals. They wouldn't be listening. They'd actually be watching. And while you're there, please like and subscribe to get our latest content. You can follow us on Twitter at The Market Huddle. We're on Twitter every day. Give Lena a shout out. And if you please review us on iTunes. It helps us out immensely. Not immediately, but immensely. Anyways, Patrick, where can they find you?
You can find me on Twitter at Patrick Ceresna, and you can follow me at bigpicturetrade.com. Where can they follow you, Kev?
So I'm at Kevin Muir, KevinMuir, and that's my Twitter handle. And for my newsletter, you can go to themacrotourist.substack.com. And listen, you can never have too many friends. Bear market, bull market, we're just happy to spend time together on this crazy ride. So thanks. Now stick around for the after show. Okay.
So Kev, we'll bring him on, but
first.
We got to get the youngins on. But so I clearly am scheming too much, right?
Yes, you are. Literally, I see it on Twitter all the time, and I'm like, oh, I'll just keep my mouth shut. I was like, what are the chances he's going to say it again? And then there it is. It's coming up again. I had to talk about it.
Oh, you know what?
Let's get the youngins on.
I fuck up a lot of things. That's my signature thing. It's
listen, Patrick,
there's no such thing as perfect execution unless it comes to trades.
Yeah, no, but it's why we're good partners. We're both equally, inept at pronouncing things. Like I actually, Patrick, you know me, I don't usually do edits. I actually stumbled on 2 words today that I had to get edits, and I'm not going to try them because I know I'll screw them up right now.
Well, you know what? We're lucky and privileged to have Lena doing all of this because she cleans up all this shit and
we
makes us
do very
sound
little
way
editing.
better.
We're not as we're a little looser than some shows, but when I really stumble on a bad word, we fix it.
Well, it's not only that, but like she makes us sound way smarter than we are. I don't know how she does it.
I don't.
People are probably wondering, oh my God, there were edits in this show?
Yeah.
I know. You're actually making Lena seem bad because she's going to be like, boy, that's like pretty shitty if they edit that stuff. There's very little edits. It's only when I really stumble on a word that I give up and go, screw it. I can't say that. We're going with a new thing.
Okay. I got a question for Patrick. How do you say schedule? Do you say that? How do you say that?
Schedule.
Okay.
Schedule. Is that okay?
And there it's it's straight down the barrel. Yeah. Okay. But then you got scheme. That just tosses the whole thing out the window. You're a conundrum.
I love this scheme. It sounds like an Austin Powers,
Gold member.
I don't Gold member. That's it.
Was it Gold member? Yeah, Gold member.
I wonder if he does say it like that.
I love gold.
It's like Patrick was like a little tyke and he watched it and then he decided that's how you say it.
My godfather. My godfather.
Okay. So listen, we do have to talk about we have to talk about something really serious though.
Oh, okay.
Kidding aside, I have sent off to everyone a very disturbing newspaper or article that I found, and it had to do with somebody was telling me about some trade that I had done that I'd actually luckily gotten right, and I said something about the blind squirrel every now and then finds a nut. And I thought to myself, well, you know what? In this case, it was kind of almost a prairie dog formation. So I thought, I'm going to kind of change it, and I'm going to make it whatever the prairie dogs eat. So I looked up what prairie dogs eat. I Googled that. Because I didn't know. Patrick, do you know?
No.
I don't know. Taylor and Lena, do you guys know what prairie dogs eat?
Well, now I do.
No.
But,
Well.
we'll let you take it.
They eat grass or whatever, right? So I was just trying
They're vegetarian.
They're vegetarian. But then I found this very disturbing article, okay, and I'm going to read it to you guys. Prairie dogs don't eat meat, so why are they serially killing squirrels? The vegetarian animals regularly massacre squirrels, which they may see as rivals. So these things, even though they're a noble animal, they are stone-cold killers. Right?
What?
These things, and yeah. Did you not read the article? Typically squirrels. Okay, so they're victims, typically squirrels, who die in a violent and bloody fashion. I describe the behavior in 8 words. Catch them, shake them, kill them, and leave them, says John Hoogland, a professor of University of Maryland. Now, this is where it gets a little bit, I don't know if I should talk about this in the Me Too movement. Do you think I should bring this up? Do you think it's okay, Lena?
Maybe I should just read it.
Actually, why don't we let Lena do this? Lena, this is more your place. So why don't you take over after that part where it's
I can relate to this.
Yeah.
So the study found that most of the prairie dog killers were female, and female prairie dogs were also more likely to become serial killers.
It's kind of like nature fixing the balance of the most serial killers are male. So it's just fixed.
I guess in prairie dogs, that's just females.
Yeah.
Good for them. In fact, the female serial killers will often dispatch their victims and then go on to graze peacefully or play with their babies as though nothing had just happened.
It's like the Ted Bundy.
Yeah, it's so crazy.
Who would have known?
Who would have known? I never would have suspected this.
I would have never thought. I thought no animals killed for the sake of just killing. I always thought they only killed to eat. I thought humans were.
Yeah,
now we know the prairie dog.
They kill for sport.
Well, or they kill because it's I don't know.
Competition.
I hear dolphins actually hunt people.
What? Dolphins?
I don't know. I just that would be quite a vacation. Let me just tell you.
I was like, that's gonna shock my children.
Yeah. Yeah, I hope all these
Killer
people,
dolphins.
Yeah,
I actually think the dolphins are super nice and that they've been known to ward off sharks when there's been humans around.
Oh, is
So
that right?
you're trying to
Yeah,
malign
yeah.
the poor dolphins, and they are actually the heroes of this story.
Yeah, we should be clear about this
You're
podcast.
heartless.
We are pro dolphin on this podcast by far,
Now,
for sure.
but although we love the prairie dog, we have concerns about their serial killing.
Yes.
I'm not
Yes.
judging. Maybe the squirrels were asking for it.
Maybe somebody wrote a malicious article about a one-off prairie dog that is not representative
Maybe there was
of the
just
larger herd.
You're right. Maybe there's just one crazy prairie dog, and she
That
just,
happens
like,
to be in the
killing-
study.
Well,
Yeah,
yeah,
and-
it does say it's not that certain nasty females only do this. It's a
Yeah.
bunch. So, but I don't know why they threw a nasty in there. That just seems like it's. You didn't have to say that. What makes I'll just drop it.
So I don't know. We'll have to decide if we can still call them a noble animal. But we're not changing the prairie dog formation.
No, we can't do that.
Well, but the noble animal might be up in the air. Well, might have to come up
Yeah,
with
I think that's now questionable. I
Yeah, I
No,
think it is.
I still think it's a noble animal.
Do you? I don't know.
You
we
know
can
what?
come up
One
with
one
another-
story. I need more evidence.
You know why? You know why Patrick thinks that they're still noble animals?
Please tell me.
Because Patrick eats squirrels.
Oh
That's true. That's true. This is his
so
squirrel
true.
bias. He's actually anti-squirrel. So although we're
My
pro-dolphin,
mama
we're
makes
actually
a great squirrel stew.
For people who are listening to this for the first time, we're painting a very bad picture of Patrick.
No. Listen,
Is
he killed a squirrel and he ate it. If you're a hunter and you eat what you kill, it's fine.
Although
It's a- it's a-
Patrick, it's
Yeah.
probably not stew. It's probably more like stew.
Stew. I love stew.
Oh God. Oh God.
Well done.
We should leave it on a high note.
I think we should just leave it there. I think
All
that's
right.
the perfect.
Yeah,
end of the
leave
show.
everyone with the idea. Why does Patrick eat squirrels? I think that's a great way to end the show.
If you want to defend yourself, I stuck up for you and said that as long as you kill something and you eat it, you're good. I was on your side.
I'm not even going to go and tell the story anymore. It's fine.
Well-
It's just,
it's
we're
already
cutting
out
it.
there.
We're cutting it
Yeah.
right
So the
here.
fact that you were hunting with a 308 and there was barely any meat to cut, like to cook, was a problem. But otherwise, it was good. It's good.
All right. Anyway, have a great weekend, everyone. It was good shows. We had great guests.
We did. It
They
was
were
terrific.
all so
Really
awesome.
good.
It's it was
Terrific.
and great
Have a
great
week,
job,
everyone.
Taylor. Yeah, Taylor, great job on WTF. Lynn was great. Lena, good luck.
Yeah.
Have a long night
Poor
ahead.
Lena always has the job ahead of her when we're all done and we go off.
We're
and
done,
Poor
and-
Lena, poor Lena has to spend Friday night and all, Saturday morning fixing it.
Well, half the time I'm doing the job like half drunk, right, from drinking beers.
Ah.
So it's
That's
much
why
more
it sounds so
difficult.
good.
Yeah. Anyway.
Wait,
Wait.
Yeah,
we
we
screwed
didn't
up.
rate the
We didn't
beer.
rate our beers.
Oh my gosh, it's been so long.
Yeah, it has been so long. We fell down. Okay.
I'm
So
going
there's only three of
first.
us drinking. Taylor's not going to be doing.
No, I'm drinking a Brio. It's an Italian soda. It's also blood orange.
Nice.
Ooh.
Well, there you
I
go.
give it a
So
1.
You don't.
A
You
1 out
don't.
of 5.
1 out of 5. Okay, so Patrick, here we go. Oh no, Patrick will do last. 'cause he's gonna
This-
like it the best.
Okay.
Lena,
I'll
you go
last.
first. Ladies first.
I have to say I was very impressed, even though this was a sour. And I would give this an 8.2.
Whoa, that's a high rating.
I'm impressed. I like
Okay,
it.
so you guys know how much I hate sours, right? Has there ever been a sour that's been above 5? For me,
Probably not.
I don't-
Maybe there was an odd one here.
I
and
don't
there,
think
but
so.
Nothing notable.
I am going to give this, and maybe it's just I don't know. I'm going to give it a 7-1, which to me is
It's a
outstanding
really
for a
good
sour.
Well,
Actually, that's too high. I feel bad that I said that. I wish I could take it back, but I bid it.
oh
so I'm,
no,
I'm
you did
stuck.
it. You did it. So you
I'm
can't
bid.
take
I'm,
it back.
I'm bid. And
back.
someone's filled it, so it should be lower. But anyways, I own it at 7-1. Okay, Patrick, go.
I would rate this as a 9.
Oh my God.
9.0. Yep. It's delicious. It's delicious.
Patrick,
you know what?
You're young at heart, buddy, because you know what? Your politics and your thinking is like a 75-year-old man, but your beer taste is like a 25-year-old millennial. I like it.
Oh, there goes a millennial.
I know there's only one.
Waiting for you to say that the whole show.
I made it. Only one. Only one. I did really well.
Yeah.
Patrick had like 4 schemes.
I was scheming.
Anyways,
I was waiting for that.
have a great weekend, everybody.
All
Thanks
right.
for listening.
Have a good weekend.
All right. Take care, everyone.
Bye-bye.
Cheers. Bye-bye.
See ya.